Guess what? If you don't have a broker, you can't make money in the market. If you can't make money in the market, you can't achieve all the goals you're hoping and wishing for watching endless YouTube and TikTok videos on trading every single day. Believe it or not, most people that want to get involved in markets say they're too frightened of opening a brokerage account. Too frightened? Okay, feeling cautious, that's only natural when you're doing something for the first time. But it's not that complicated, so put down the charts and the price action for 5 minutes and let's talk brokerages.
Okay, we'll split it into 4 clear sections. Number 1, which business model you should choose. Number 2, the various levels of service. Number 3, rules and regulations. And number 4, trading conditions. That's things like leverage and margin. Let's talk about the business models first. There's 3 main ones that brokerages use. They are dealing desk, no dealing desk and straight through processing, and then also ECNs as well. This is the first one, dealing desk. And it's, to be honest with you, one of the most popular ways of getting involved in markets. What it basically means is that the brokerage is a market maker. So they will have a responsibility to give you, the customer, a passive two-way price at any point in time and offer you a price that you can sell at and a price that you can buy at. They will be the counterparty to your trading activities. And as a consequence of that, some people will criticize this model and say that there is a conflict of interest as the broker will trade against you. But it is a very transparent, clear relationship. They will go into the market and they will hedge their overall exposure depending on how their clients are positioned. They'll also offer you a fixed spread, no doubt, as well. And that's good when you're getting started because you know what your costs are and you know exactly what the landscape is as the charts are moving around. You know what that cost base is. They'll probably offer some simple software as well to get clients into what it's like to trade in the markets, and you're not going to be bogged down with learning too many complicated things at the same time. And quite often as well, in a dealing desk model, you'll find that there's a lot of bonus incentives as well, deals to get people involved in opening an account. So that is a dealing desk model. Next is the NDD-STP model, and that stands for no dealing desk, straight through processing. In this model, your broker acts as a middleman. So if you're the client here, you put your order into the broker and your broker passes it straight through to their liquidity provider, who then fills that order for you. As a result, your broker is not your counterparty. Many would argue that is a much more transparent way of working too. And as a result, you will have a spread that is probably floating and is also going to be much smaller than a fixed spread as well. The final one is an ECN, which stands for Electronic Communications Network. This is a very popular way to trade, and a lot of retail traders work like this. Your broker basically stands to one side and passes your order onto a whole network of liquidity providers, and you get filled from the best price from the liquidity providers. As a result, you are anonymous. You don't know who your counterparty is, and you don't know who you are trading against. Some people quite like that because they say there's no conflict of interest at all. And as a result, you'll get a very, very tight spread. The way that that is done is the broker's price matching software is constantly scouring the network, looking for the best bid and offer at all times, and then offering that to the client. So you are going to get the best possible price at that particular time. One thing you will have to accept is that you will have to pay commissions as a result of trading on an ECN, because that's how the broker is going to be making money, making their business. And there is an element of risk involved in working with an ECN, and that is, if things go wrong, if there's a big market crash, if something unexpected happens in the market and the whole system sort of just explodes and the spreads really widen, you are at the mercy of this network of liquidity providers. There's nothing that your broker can do. So therefore, the actual slippage that you'll get when things go wrong is potentially a lot higher. And that does add an element of risk. Now, if you're happy to accept that risk, this is a great way to work, and you'll get fast execution as a result of that. But those are the 3 main business models that you'll get to choose from.
Okay, let's talk about levels of service next. Remember one thing, brokers like turnover and volume. So the larger you're trading, the more volume you're putting through the business, the better quality of service that you're going to get. Have a look at the trading platforms that they've got on offer. Most should offer MT4 as standard, but there'll be plenty of brokerages that also offer their own bespoke platforms. Are they any good? I don't know. give them a test drive, but don't be bullied by a broker that is trying to push you into using their own platform. Remember, when you leave that brokerage and go somewhere else, you're going to have to learn new software from scratch because you're not going to have access to that software anymore. Also look at what add-ons they've got as well. Do they offer any risk management plugins or any risk management software, automated charting tools, that type of thing, profit and loss calculators? That's always good stuff. And if you don't ask, you don't get. Test out the customer services as well. What are they like? Are they fast? Are they knowledgeable? Are they open 24/7? They certainly should be, because when you need to speak to someone in an emergency, you really do need to speak to someone. See what they are like by talking to them. And also remember that they are your connection with the brokerage, so it's worth being on good terms with them. A lot of brokerages will also offer premium services. Check out what they are. Some will offer trading advice, research, education, tax planning. Some will even offer retirement advice if you're trading your retirement funds. All this is great, but remember, added on services usually come at a premium and will probably cost you money at some point down the road. So let's talk about rules and regulations. You're going to want to work with a broker that is regulated. Regulators change from country to country and the rules are different, but they basically lay out the groundwork and the regulations for how the brokerage can work, what they are allowed to do and what they aren't allowed to do. There are various different ones around the world. These are some of the big ones around the world that are certainly worth noting. You've got the FCA in the UK, you've got the SEC and the CFTC in America, you've got ASIC in Australia. They are pretty good, and you've also got the FSA in Japan as well. And this one here at the bottom, this is the one in Cyprus. This is CISIC. There's a lot of retail brokerages in Limassol in Cyprus, and that is a very popular place to set up brokerages, so they are good too. So any of those are certainly okay. There's three things that you want to bear in mind in what the regulator is setting down. First up, the regulators should dictate that the broker has to adhere to the net capital rule. That basically means that the broker has to have a certain amount of money liquid in the company at any point in time. So if there is a problem, then the administrators can come in and there's money to give back to the customers. The second one is also segregated client accounts. That's pretty straightforward. Your money should be in an account that is ring-fenced and is there purely for the purpose of trading, not for the broker to use for any other purpose. This one here at the bottom here, in the UK, the government here also offers like a deposit insurance scheme as well, so that the people that are putting money in the accounts, there is an extra layer of protection as well.
Finally, let's talk about trading conditions. Now, as a retail trader, it's more than likely that you'll be trading OTC, which means over the counter. That means that there's no exchange in the middle of all of this. We'll also be trading on margin as well. What does that mean? Well, it's just like getting a mortgage. You put a deposit in when you want to buy an apartment or a house, and the bank puts in the rest to make up the entire purchase. It's the same when we are trading. So if you fund an account with $1,000, if there's a 1% margin from that broker, you could then trade up to $100,000 worth of currency against that deposit that you've put in there. Now, the way that we get there is by understanding leverage, and leverage is the factor by which we multiply the deposit amount to arrive at that final amount that you can trade. And so you can see if we divide 100,000 by 1,000, we get 100. So in this example, the leverage on this account will be 100 to 1. Now, there's one key point that pretty much every retail trader misses and misunderstands when they think about margin and leverage, and it's this. The broker sets the amount for trading on margin. They stipulate what that value has to be, but you get to choose how much leverage you employ. So even though they're offering you 100 to 1 leverage, you don't actually have to take it. You can trade with much smaller if you want to, but that's the maximum that they will allow you. You have control over that. However, this here, the actual margin requirement that they stipulate is something that they dictate, and you have to adhere to that. And what you'll find in times when there is a crash or something like that, margin requirements will go up. But that is the basic structure of how the trading conditions work. There's also various different fees and commissions depending what they are. but they will all be different from broker to broker. So never assume that it's always going to be the same. They're always going to be different.
When it comes to initially opening an account as well, the deposit amounts may be different. And you can see on the the broker comparison page of our website here, you can see these are all our partner brokers. Our main one is Switch Markets here, you can see, and their deposit amounts are different from some of the other guys as well. So it really does depend on broker to broker. Finally, is to consider the rollover fees. Now, if you hold a currency position open past the close of the session, from the US session into the Asia session for the next day, you're going to either pay or be paid a fee for holding that position open. It's based on the interest rate differential between the two currencies that you are trading, and it will again be different from broker to broker. Usually that'll double up on a Wednesday because they don't apply it to your accounts at the weekends. But if you want to just check what they are, you can see here in the Switch Markets account, if I go to the pound against the US dollar, if I right click in MT4 and go down to specification, you can see exactly what that is. So if you hold a position long, it says there swap long, that is what you get charged, minus 4.68. And if you are holding a position short overnight as well, you actually get a little bit of interest. You actually get paid to hold that position open. That will depend on broker to broker as well, so it is worth checking out. And that is pretty much it. There's lots of different types of brokers out there, and you'll find something that fits what it is that you're wanting to do in the market. Don't be worried about picking a broker. The best thing to do is to always do some research first, speak to them, talk to them, ask them questions, and also test stuff out before you end up sending some real money to them. Don't forget to like, comment, and subscribe, and we'll see you in the next one.